Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. So in this podcast, you're going to learn about cost segregation. Now, you understand the first word, cost. Segregation means breaking things apart. So if you don't really know how that kind of ties into real estate investing and what that could mean for your overall tax liability, I think this is your show. No, I don't think it's your show. I know it's your show. We're going to have a great time. We have a guest. His name is Yonah Weiss. I love talking about this topic because it's like going to the dentist. Right? You always like learn something new about your mouth when they like open you up. I'm excited because I'm sure I'm going to learn something new every time I talk to Yonah. So it's going to be a fun conversation. And then after that, we're going to have a little surprise topic that I'm going to talk about for a few minutes, and then we'll end the show. So roughly about 17 minutes here. I'm excited about it. And I do want to give a huge shout out to the sponsor for today's show, which is Real Property Management, which is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. You can learn more at realpropertymgt.com or call 888-806-7088. Let's jump in. Yonah, give us a little background. Who are you, and why should real estate investors care about cost segregation?
Well, thank you very much for hosting me here, Abhi. It's a pleasure to be here. You really only care about cost segregation if you care about money. So, simply put, basically anyone and everyone who's investing in real estate knows that tax benefit or tax deductions, the tax aspect of real estate is one of the greatest reasons why people invest in real estate, for the tax benefits that come along with it. And so when people refer to the tax benefits that come along with real estate, it's usually cost segregation, even though they may not even know that, but that's really what it is. So a little bit about me. I actually have a background in teaching. I was an educator for about 15 years and got into real estate about 5 years ago. Many different aspects of the industry, just learning because of my passion for learning and teaching. It just seemed natural to just go from one thing to the next and try to find out where my niche is, where my calling is. I find a passion in helping people, and this is a great way to do it by helping people save taxes, basically pay less to Uncle Sam, keep more of your own money. And in a nutshell, that's what it's all about. So why? That's the why. Okay, we'll get into the how, I guess, shortly.
So yes, from a high level, like bird's eye view, high level, and I know we could like really go down a rabbit hole with this. So keep me honest and keep me on track, right? I know generally I'm supposed to keep like the conversation on track, but I have a bunch of questions for you. So I'm transferring that responsibility to you. From a high level, what do I need to know about cost segregation so like I can start having or seeing a benefit and impact on my financial bottom line so that's question number one, followed by like question 1B, which is, if I'm a single family residential rental investor, can I take advantage of this? If I'm a flipper, do I take advantage of this? Or if I'm a commercial real estate investor, can I take advantage of this, commercial/multifamily? I know it's a lot, but hit me with it.
Awesome. Great questions. And I might take the second one first because it really will give a little more context to it. Cost segregation is it's really what it is depreciation. Okay, that's all cost segregation is. It is a very fancy way of saying depreciating your property in a really special, advanced way. That is really the way you should be depreciating your property. And when I say depreciating, I mean taking a tax deduction called depreciation, not actually lowering the value of your property. It's literally a tax write-off, a paper loss that doesn't really have anything to do with the fact whether your property is going up or down in value. It's really just a tax deduction IRS gives you based on the property value. So that being said, it is for any type of property whatsoever besides for your personal residence. So any type of rental property or business property. The one exception besides your personal residence is a fix and flip if you're not holding it for rental. Okay, again, this is rental property income. When you have rental property income, or business income from a business property, you are allowed to take this tax deduction called depreciation off that income. Before you even get taxed on the income, you take these deductions first. So fix and flips does not apply to there. So you really need some rental property in order to take advantage of this deduction. So that's kind of the first, what types of properties. Second question, which is really the first, is if you have a single family, if you have anything, really any type of property whatsoever, it can benefit you, because what we're doing is we're taking a portion of that depreciation, and what we're doing is just front loading it. Okay. Cost segregation, in a simple way of understanding it, is maximizing those deductions by front loading a certain percentage of them, a certain portion of them, into the first year or into the first 5 years, as opposed to waiting 39 years to take a little bit every single year of those tax deductions.
So, okay. So that makes sense to me. But why wouldn't I wait the 39 years per the IRS schedule for a single family rental? Because then I can take the depreciation, year after year, month after month, and just kind of keep that going. And that helps my cash flow. Why not do it long term versus taking everything up front?
Right. So what we're doing is we're taking a certain percentage up front. So we're never going to take the entire amount of depreciation. And just to give a little more context, we're taking, the purchase price of that building, and we're now dividing that by 39 years, or for residential properties, 27 and a half years. So essentially what we're allowed to do is, from the day we purchase the property, we're allowed to take a little bit every single year. So we ask, why not take it, just take that little bit every single year? The advantage of cost segregation works best when you're talking about a real estate investing strategy, not necessarily if you're just a person who buys one rental property for the next 20 years and that's it. So what happens when you have rental property income? You can create this deduction, this depreciation deduction, and take 20, 30% of that in the first year, the first 5 years, which basically negates and cuts out all of your tax liability whatsoever, that's increasing your cash flow right off the bat. Not only that, if you buy, next year you may have less depreciation, or in 5 years from now, you may have less depreciation. You're going to have 80% of that depreciation. But what you do have is potentially other properties that you're going to have more depreciation deductions from. So this works best with an overall strategy when you're able to literally knock off your tax liability entirely, okay, by creating these huge front-loaded tax deductions. And, we understand the concept of compound interest, of using your money to reinvest. Not only the time value of money, that you can actually, money that you have today is worth more than this 5 years from now. So that's in itself a great reason to take advantage of these tax deductions while you can. But if you now take that cash flow that you don't have to pay taxes on, reinvest that, what you're doing is creating, exponential growth of that money than you would had you paid taxes on those.
So it's a way, So it's a way of benefiting on the tax side so that I get the ability, instead of paying money in taxes, I can take that money I would have paid, throw it into another deal, and kind of keep the ball moving.
Keep growing your wealth.
So two questions. One, how much does it cost me? And two, how does it work? But let's start with the how much does it cost me? Is that dependent on the property size, where it is? I guess that's my question.
It's a property-to-property basis. There's a one-time flat fee based on usually the size and the scope of work of the property, not contingent to your tax savings. So when we talked about, any type of property can benefit, but the more the property value is, the more benefit you're going to have, because the fee involved in getting a cost segregation study done is going to be relatively around the same cost if it's a single family versus if it's a 300 unit multifamily building, or if it's, a 50,000 square foot, retail center. The cost is not going to be that much greater to get the study done. So somewhere between, in our cost Madison specs, I'm speaking 2020, right? Our fee, our fees this year, somewhere between, I'd say, $4,000 to $6,000 is the range. Maybe on smaller single families, it might be a little less than that, and larger, massively large million square foot commercial buildings are going to be, greater than that amount, but that's the average cost. That being said, when you look at the purchase price, the deal size, it's really going to start making sense, and not just making sense breaking even, but making sense like 10x your investment of that $3,000-4,000 when you have a property that's purchased for over $500,000. Okay, so single family $100,000 rental, doesn't really make a lot of sense. You're going to pay $3,000 to get $10,000 of tax deductions. It doesn't really make a lot of sense.
Gotcha. So this would be good for maybe a small 5, 6, 7 unit multifamily, something that I'm buying in Indianapolis, right? For that. But like you said, if I'm buying a $30,000 house with no sink in Birmingham, Alabama, then it's probably not no sense.
It doesn't make a lot of sense. That's right. And this is probably the reason why so few people know what cost segregation is, because a lot of people can start in real estate on a smaller scale, right? They're getting started on buying single families or investing in small deals. And this really doesn't become relevant until you kind of are, getting into deals that are a little bigger, that you can actually take advantage of this tax deduction. So it kind of gets missed in the education. So, I'm grateful to you bringing me here, because it's important for people to know, regardless of what size deals you're dealing with now, you have to know, what you may be dealing with a year from now or 2 years from now.
So how does the process work? So let's say I purchased a property that's roughly about $500,000 in size. I'll use that size in air quotes.
Sure.
What are the next steps? Like, I have to go where? I have to get in touch with you, obviously. But do I have to fill out certain paperwork? Help me kind of put the dots together.
Absolutely. So it's a pretty simple, straightforward process. Some people trying to figure out, well, doesn't this have to do with accountants? Doesn't my accountant do this? Isn't this like a CPA thing? So the answer to that is no, it's really an engineering thing. Okay. The process involves engineers, and how it works is like this. An engineer, a cost segregation engineer, comes to your property and identifies all of the things in the building that depreciate at a faster scale, create a very detailed report of that by identifying personal property like furniture, cabinets, carpeting, right? Things that depreciate on a 5-year schedule, and other things that creating this report. But even before we get to that report, we always run a free analysis. So this is the most important thing, because it's really educational. When you know ahead of time, you buy a deal or you're even under contract in a deal, and you're looking, hey, how much tax benefit am I going to get by doing the cost segregation study? You'll know upfront already, even before going through with it. So that's the first step. Always reach out, get that free analysis. Once you have that and you decide to do it, yes, we will send an engineer to the property. We've actually created a smart tour that we're doing virtually now because of the current situation, which allows our engineers to go kind of virtually into the property with the help of someone on site. And we come back, take pictures, measurements, et cetera, create this very detailed, 100-page report that has in it a new updated depreciation schedule. And that one page is what you hand to your accountant, because all that is telling you how much you can deduct in your taxes this year and for the next, life of ownership of the property.
So and then we got 2 more questions for you. How does recapture work? I'm thinking about this because at some point in time, the depreciation is going to be recaptured back into this life cycle of things. How does that work if I'm, say, front loading, say 40% of that, and if I'm taking 40% of the depreciation as a benefit, say year 1, help me understand, A, the definition of recapture, and then B, how this kind of fits into the overall formula of cost segregation.
Absolutely. Great question. Yeah, the IRS is not like our best friend, right? They don't have a reputation for doing things.
That's right.
Right? To benefit us, altruistically. Okay. So yes, there is some might call it a catch, but recapture tax. Okay. There's a tax that you get hit with when you sell a property. Okay. And that's called depreciation recapture tax. Everyone knows what capital gains tax is, which is a tax on the amount of profit you made from the sale of a property. There's also recapture tax, which is that you're now taxed at 25% rate based on the amount of depreciation that you took. So if you front loaded 40% of that depreciation into year number 1, then it's really pretty straightforward. You know what you're going to be hit with, ahead of time. So it's important to kind of plan this ahead as your business plan. So that's what recapture tax is. However, to understand the full picture, we really need to understand how to get over recapture tax, right? How to get around it, okay? And how to use other strategies that combine with cost segregation to maximize our tax benefits overall, okay? So one of those things is what's called a 1031 exchange. People probably heard of that. It's a way to buy a property, and instead of doing a regular acquisition, you're doing an exchange for a new property.
Yeah.
And by doing that, you can avoid capital gains tax, and you avoid or defer the depreciation recapture tax as well. So that's one way to get around it. The other really popular way is, like I said, this is an overall strategy. If you're in the business of buying properties and scaling, buying one this year, another next year, so it's very likely that by doing the cost segregation on one property and creating this huge tax loss, right? Loss meaning that you have more deductions than you actually have income. So having more deductions than you actually have income is actually a good thing, because not only does it carry forward and you can use it in future years, not necessarily this year, but you can also use that to offset the depreciation recapture tax if you have that on the sale of another property.
I love it. I absolutely, so that is exactly the smartest, absolute smartest thing to do. Like I love this, right? Like you've just been
right
on fire with that info, and I really want folks to understand what Yonah just said, right? Like there are two strategies you can use to get around. Eventually, listen. Eventually, you're going to have to pay the piper, right? Like you cannot evade paying taxes. But you can get around not paying taxes for a long time. So like, I'm okay with the latter. I'm not for evading taxes. Like if your intent is to like open some type of offshore account and like stash money there, then you might as well go be Bernie Madoff's bestie. Like that's like right up your alley. But if you want to play the game smart, then getting in touch with Yonah so he can help you navigate these waters, I think is a really interesting concept. And I love the advanced strategy, right? Like we went from cost segregation to recapture, to what recapture really means, and then how you can avoid, not evade, how you can avoid recapture for 5, 6, 7, 8, 9 years. And really, losing money on a paper loss is a very good thing if you're a real estate investor. And if you're a beginner, get in touch with Yonah. He can explain that a little more. If you're a pro, you already know what I'm talking about, which is fantastic. So, all right, Yonah, we got to wrap up. What's the best way to get in touch with you? Because you've clearly schooled me on all of this, and I've learned so much. I appreciate the insight and all of the helpful analysis. How do I get in touch with you? How do I get the process started on this entire cost segregation thing?
Yeah, if you want to get a free analysis, like I said, or ask any questions, you can find me on LinkedIn. That's the place I'm most active. You can also go to yonahweiss.com, which is on my website there. I work for Madison Specs, which is the largest national company that does cost segregation. So you can go to madisonspecs.com as well. But on my website, I also have a place to fill out a form and just get a free consultation and get a free analysis on your property. So yeah, I appreciate you having me here, Abby. It's great.
You got it.
It's been a lot of fun.
Yeah, thanks a lot. And I appreciate you going down some of these rabbit holes with me. Like I said, I had a couple questions. But the most important question I have for you, what beard oil do you use? I'm just jealous. I appreciate the background, by the way. I appreciate the virtual background that you got. Yeah, that's awesome. But like, where's the beard? Like, what do you? I'm jealous. Like, I want the fluffy. For the life of me, I just have the hardest time growing it out, and then it just grows out in weird patches. It's just not good for me.
Yeah, it's, actually don't use the beard oil. I'm pretty natural about it. Shampoo, conditioner, just keep it real, keep it simple.
Nice. Well, hey, you have a believer in my book. Like, I love it. Well, cool, man. Thanks a lot. I got to jump. I know you have to as well. Everybody needs to check out yonahweiss.com and more information there for sure. It's an awesome strategy. Yonah, thanks so much. I appreciate the time. This next segment is brought to you by AaronBChapman.com, where you can bypass all the overcomplications of the common suit and tie mortgage guy and connect with Aaron Chapman and his team of real estate investment finance experts at Security National Mortgage. No fluff, No complicated industry speak, just brutally direct action. Visit Aaron B. Chapman today for more information. That's aaronbchapman.com. Let's talk about the 5 killer markets. Right now, I'm excited for this because I don't know what these are yet. I'm just kind of looking at this. Number 1, 2, 3, 4. There we go. Tulsa, Oklahoma. Number 2, Salt Lake City. Number 3, Tucson, Arizona. Number 4, Virginia Beach, Virginia. And number 5, Cincinnati, Ohio. Let's talk about Tulsa for a second. Tulsa, quote, has seen the biggest drop in demand of any metro market that was studied, and the only metro market that saw a decrease in every metric examined. And so what's interesting about Tulsa, and from what I'm taking a look at, okay, Tulsa's contract ratio, which is the pending sales to active listings contract ratio, decreased by 80% since mid-April, and the proportion of homes sold within 2 weeks dropped by more than 50% between April and June. Holy cow. So what's nuts is when you see metrics like this, and when you see this significant of a drop, what do you want to do? You want to buy, right? Like, this is, if you didn't buy stocks over the last couple of months, I'm just saying, right? Like, you kind of missed out on a pretty awesome opportunity. Don't miss out on these opportunities. Tulsa, Oklahoma being the top one. Salt Lake City. Prices in Salt Lake City, they're saying, haven't really yet declined as much as they could, but there's still a paralysis in Salt Lake City. Coronavirus numbers trending upward, and it's unlikely that prices will stay high for pretty long. So it's being predicted that Salt Lake City could start to see a little bit of a dip. So ding, ding, potentially buy. I like it. Tucson, Arizona, Virginia Beach, Virginia, and Cincinnati, Ohio have very similar indicators. So we want to take a look at some of these markets that are here, that are, could, you know, like, it's like that an inflection point, and you want to be the first there before everybody starts to flood the markets. So start taking a look at these 5, and you heard it here first. Think Realty Nation, that's the show. If you have any questions for us, you can get in touch at thinkrealty.com. Certainly appreciate the sponsor for today's show. We can't do it without you guys. Real Property Management, the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. You can learn more at realpropertymgt.com or call 888-806-7088. Man, I learned a lot. I learned a lot about cost segregation, and then even how to get around it, how to avoid it, not evade it, but how to avoid it. And thank you so much, Yonah, for giving all those insights. I mean, that's super, super awesome. We talked about recapture, which is not talked about enough, which you need to learn about. You can't just take depreciation, not pay the piper at the end of the day. So you want to look at what recapture could mean to your overall portfolio as well. All right, you know how to get in touch. Thank you, Realty Nation. Until next time, happy investing.